Now speaking, Pankaj Gupta, Vice President, Investor Relations. Good morning and thank you for joining our webcast today. I'm Pankaj Gupta, DOW Investor Relations Vice President. Joining me today on the call are Jim Fitterling, DOW's Chair and Chief Executive Officer, and Howard Ungerleider, President and Chief Financial Officer. In this call, we will review our second quarter results and operating segment performance, provide our outlook and modeling guidance, update on our cost savings actions and financial position, and outline how we are continuing to advance our long-term decarbonize and grow, as well as transform the waste strategies. Our second quarter results show strong performance in our core businesses, with sales of $10.3 billion and adjusted EBITDA of $1.7 billion. We also delivered strong cash flow from operations of $1.2 billion. Our operating segments performed well, with all segments delivering positive year-over-year adjusted EBITDA growth. We are also making progress on our cost savings actions, which are expected to deliver $400 million in annualized savings by the end of 2021. We remain focused on strengthening our balance sheet and have taken proactive steps to reduce our debt and improve our liquidity. We are also continuing to advance our long-term decarbonize and grow, as well as transform the waste strategies, while now speaking, Jim Fitterling, Chairman and Chief Executive Officer. Thank you. Despite the challenging macroeconomic environment, Team Dow delivered sequential earnings improvement by executing on our financial and operational playbook. We leveraged our diverse portfolio to capitalize on gains in packaging and modestly higher seasonal demand in building and construction. This resulted in a sequential improvement in volume, and we implemented our $1 billion of proactive and targeted cost savings actions, delivering $250 million of savings in the quarter and $350 million year-to-date. Net sales were $11.4 billion, down 27% versus the year-ago period, reflecting lower demand and prices due to slower macroeconomic activity. Operating EBIT for the quarter was $885 million, down from $2.4 billion in the year-ago period, primarily driven by lower local prices. We generated cash flow from operations of more than $1.3 billion, up more than $800 million versus the prior quarter, driven by improved working capital. On a trailing 12-month basis, our cash flow conversion is 98%. We returned $743 million to shareholders through dividends and share repurchases. Year-to-date, we've returned nearly $1.4 billion, and our balance sheet remains healthy, supported by strong investment-grade credit ratings. In the second quarter, Team Dow delivered sequential earnings improvement by leveraging our diverse portfolio to capitalize on gains in packaging and modestly higher seasonal demand in building and construction. This resulted in a net sales of $11.4 billion, down 27% versus the year-ago period, and operating EBIT of $885 million, down from $2.4 billion in the year-ago period. We generated cash flow from operations of more than $1.3 billion, up more than $800 million versus the prior quarter, and returned $743 million to shareholders through dividends and share repurchases. Year-to-date, we've returned nearly $1.4 billion, and our balance sheet remains healthy, supported by strong investment-grade credit ratings. We also published our 2022 Intersections Report in June, which showcases Dow's continued progress on our ambition to be the most innovative, customer-centric, inclusive, and sustainable materials science company in the world. Now speaking, Howard Ungerleider, President and Chief Financial Officer. Good morning, everyone. We are expecting a challenging macroeconomic environment in the third quarter. Inflation is moderating, but consumer demand is being impacted by tighter monetary policy and slower than expected demand recovery in China. In the U.S., industrial activity remains weak, but consumer demand is resilient due to low unemployment levels. In Europe, recessionary conditions persist and are expected to continue, despite lower energy prices and inflation. In China, while we are experiencing growth, the anticipated economic rebound following the end of zero-COVID restrictions has yet to fully materialize. Around the rest of the world, India's manufacturing PMI expanded to 57.8 in June, while ASEAN manufacturing PMI remained in expansionary territory. Manufacturing activity in Japan, however, retreated back to contractionary levels. In the packaging and specialty plastics segment, industry polyethylene demand increased 4% in June, but we exited the second quarter at lower price levels, which are expected to drive lower average prices sequentially. Additionally, higher ethane prices on the U.S. Gulf Coast and increased planned maintenance turnaround activity at our cracker in St. Charles, Louisiana are expected to be a $150 million headwind in the quarter. However, we do expect to generate a $50 million tailwind in the quarter as we continue to implement our cost savings actions. In the industrial intermediates and infrastructure structure segment, while demand in energy and markets remains resilient, we expect continued demand pressure in consumer durable and markets. We anticipate a $50 million tailwind from our cost savings actions, as well as a $25 million tailwind following the completion of a planned maintenance turnaround from the second quarter. Additionally, following an unplanned event at our Louisiana operations this month, our preliminary estimate reflects a $100 million headwind to earnings. In the Performance Materials and Coatings segment, we expect continued price pressure in siloxanes, while seasonal demand remains below normal for building and construction end markets, together contributing a $50 million headwind. Our cost savings are on track to deliver a $35 million tailwind for the segment. Additionally, the completion of second quarter turnarounds at our Carrollton and our Zhangjiagang siloxane facilities are anticipated to contribute a $25 million tailwind in the third quarter. All in, we expect third quarter earnings to be down approximately $150 million sequentially before the impact of the Plaquemine outage, as a result of the $50 million higher turnaround expense and the $100 million in project-driven licensing sales which will not recur. We are on track to deliver our $1 billion of cost savings in 2023, and our debt and credit profile gives us significant flexibility and optionality to continue to advance our strategic priorities across the economic cycle. Now speaking, Jim Fitterling, Chairman and Chief Executive Officer. Thank you, Howard. This quarter, Dow remains confident in its long-term growth as it drives the transition to a more sustainable future with a focus on profitability and maintaining disciplined and balanced capital allocation priorities. Our decarbonized and growth strategy is expected to increase underlying earnings by $3 billion annually while also reducing greenhouse gas emissions by 30% by 2030 versus 2005 levels. Notable updates this quarter include, our FCDH unit is now fully operational and is ramping up rates, leveraging breakthrough technology to expand capacity at lower capital and cost intensity while reducing energy usage and greenhouse gas emissions. We are also preparing to submit a construction permit application through the U.S. Nuclear Regulatory Commission for our small modular nuclear energy facility in Seadrift, Texas. We plan to break ground in 2026 and are utilizing a capital-efficient approach to quickly scale production and grow our supply of recycled and bio-based products. By 2030, we expect to commercialize 3 million metric tons per year of circular and renewable solutions. Our Fort Saskatchewan, Alberta Path to Zero project will create the world's first net-zero CO2 emissions, ethylene and derivatives complex. By 2030, the project will decarbonize 20% of our global ethylene capacity while expanding our global polyethylene supply by 15% and tripling polyethylene capacity at our Alberta site. We are targeting board and regulatory approval, along with the final investment decision by year-end. Construction is projected to begin in 2024, and startup of the project will occur in 2 phases. At full run rate, we expect the project to deliver $1 billion of EBITDA annually and targeted returns on invested capital above our enterprise goal of 13%. We have also strengthened our balance sheet and improved our cash generation profile, raising our underlying earnings above pre-pandemic levels, reducing our net debt and pension liabilities by more than $10 billion, and delivering around 84% of net income back to our shareholders since spin. We remain focused on advancing our long-term strategy while navigating challenging short-term market dynamics. Morgan Stanley analyst Vince Andrews inquired, could you provide more detail on the $50 million headwind between higher feedstock costs and lower average pricing in each region for the third quarter? Jim Fitterling replied, good morning, Vince. Packaging and specialty plastics saw strong volume increases across all 4 regions of the world in the quarter. We experienced a $50 million headwind due to lower pricing in June, which was caused by new capacity coming online and inventories decreasing in China, India, and Mexico. Asia Pacific and Latin America had the highest volumes, while Europe was the weakest. Feedstock prices have risen in North America due to hot weather and ethane staying in natural gas, but we expect pricing to start lower in July with increases of 3 cents and 5 cents in August. Asia is increasing prices by $20 to $30 per metric ton in July. Deutsche Bank analyst David Begleiter inquired, Jim, what measures are you taking to offset the $50 million decline in feedstocks and pricing, and how will this affect consultant margins? Jim Fitterling replied, good morning, David. Integrated margins for the second quarter ended slightly higher than the first quarter, which was good news in North America. We expect them to improve in Europe in the third quarter. The pressure on margins here has been from feedstock costs. It's hard to predict how long they'll stay high, but new capacity in natural gas, liquids, and frac capacity should increase ethane availability. Frac spreads are currently good and NGL inventories are 15% above the 5-year average due to record natural gas production. Exports continue to be strong and we've been able to move good volume into China, despite slower GDP growth. Howard Ungerleider replied, we expect to see sequential volume growth in P and SP from Q2 to Q3, driven by increased marine pack cargo shipments. Additionally, the self-help and interventions implemented by our team in Q2 have had a significant impact on our enterprise-level numbers, with 75% of the 2,000 roles impacted exiting by the end of June. This should provide a tailwind for P and SP. Alembic Global analyst Hassan Ahmed inquired, what are your thoughts on China potentially rationalizing inefficient ethylene and polyethylene facilities, and the pace of capacity additions given the current macroeconomic environment? Jim Fitterling replied, good morning, Hassan. The near-term outlook for capacity additions versus demand increases is relatively short. We're seeing volume growth, which should help to absorb the capacity quickly. China has a NAFTA advantage, allowing them to supply more domestically and still export from the US due to our lower cost position. This puts pressure on high-cost producers. Additionally, about a quarter of the industry capacity is over 40 years old, making it highly suspect and likely to be under pressure. Polyethylene has held up well during economic slowdowns, and our cost advantage and feedstock cost advantage with our flexibility is showing through in the results. We're even seeing this in Europe, where we're cracking more LPGs and maxing out on LPGs, improving our European position. This should carry through the back half of the year. J.P. Morgan Chase & Company analyst Jeff Zekauskas inquired, can you comment on MDI price trends in the U.S. and the magnitude of share issuance this year? Jim Fitterling replied, MDI is performing well in the market, particularly in automotive. We have seen some pressure on prices due to decreased demand for durable goods like appliances. We are in the process of starting up MDI distillation in Freeport, which will allow us to retire the Lawport asset. We expect that some of the capacity announced in the industry will come on later than expected, resulting in tighter operating rates than predicted. Howard Ungerleider replied, good morning, Jeff. On the share count issue, we had to use the basic share count in Q1 due to a GAAP loss. We repurchased $250 million worth of 5 million shares in Q2 and plan to buy back at least a dilution in Q3. We have $1.7 billion left on our current open share repurchase program. Wells Fargo securities analyst Mike Sison inquired, are you seeing any signs of improvement in your end markets? Do you expect volumes to improve in the second half of the year compared to last year? Jim Fitterling replied, good morning, Mike. Volumes were down 8%, with Europe off 14%. Asia Pacific and Latin America held up relatively well, while North America was flat at 1%. We're in a global economic slowdown that started mid-last year, with GDP declining through the back half of 2019 and into 2020. Inventories are in good control, and leading indicators such as ethylene glycol and lagging indicators such as caustic and chlorine suggest we're in a slowdown. The expectation is for Q3 and Q4 to remain low, but with the Fed nearing the end of rate increases and green shoots in housing, 2024 looks promising. Vertical Research Partners analyst Kevin McCarthy inquired, Jim, what actions are you taking in the industrial intermediates segment to ensure propylene oxide supply and two-way resupply arrangements with Olin? Do you think 3Q earnings in the segment are near a bottom, or how would you describe the cycle? Jim Fitterling replied, good morning, Kevin. In polyurethanes and construction chemicals, we've been overweight propylene oxide and underweight isocyanates for some time. We're right-sizing our PO business and increasing MDI distillation capacity in Freeport, while retiring the Lawport asset. Our Olin relationship has been extended through 2035, with us supplying ethylene, energy and site services to Olin in the U.S. Gulf Coast and Germany. In industrial intermediates, we're investing in downstream alkoxylates to support growth in home and personal care, paints and coatings, agricultural sector, and pharma applications. We're de-emphasizing ethylene glycol, which is a commodity, and moving to purified EO-only assets. The additional drag in the quarter was due to hot weather, which caused farmers to miss the whole spray of crops. We believe we're at the bottom in housing and construction, and things will look more optimistic as we move into 2024. Fermium research analyst Frank Mitch inquired, can you clarify your expectation for ethane pricing in the near term? What is your outlook for Sadara in the back half? Jim Fitterling replied, Frank, ethane supply is expected to increase by 15% in the next 2 years. Currently, there is 700,000 barrels of ethane being rejected daily due to strong demand for natural gas. As the weather moderates, we anticipate ethane pricing to decrease. Sadara had a few turnarounds that impacted their results, but with them back online and strong demand in Asia, we expect to see an improvement in their performance in the third and fourth quarters. Howard Ungerleider replied, Frank, Sadara is making a number of structural and operational improvements to increase margins and reduce costs. These changes should start to show in the back half of the year. Jefferies analyst Dan Rizzo inquired, what is the expected free cash flow conversion over the next few years given the new projects discussed? Howard Ungerleider replied, thanks for bringing that up. Our second quarter trailing 12-month cash conversion was 98%. We've done a great job managing working capital and have received dividends from our joint ventures. Going forward, I'd expect an 80% cash conversion rate. During periods of low economic activity, that number may be higher, around 90%, while during periods of high economic activity, it may be lower, around 70%. So, 80% is a good normalized rate. Goldman Sachs analyst Duffy Fisher inquired, could you please walk us through the top-line guide on slide 6, discussing volume and price for each segment? Jim Fitterling replied, good morning, Duffy. Sales are expected to be down 5 to 9% in the third quarter due to feedstocks and packaging costs, one-time related items, and the turnaround at the cracker St. Charles. Volume is expected to remain steady, taking advantage of advantaged cost positions around the world. The biggest headwind will be the loss of capacity out of glycol and Plaquemine, which is a $100 million headwind. Cost savings and maintenance activities are a $40 million tailwind. Automotive demand has been relatively good, but housing and construction has been relatively weak on the polyurethane side. Siloxanes have seen price pressure, but if it remains flat, then there may not be as much of a headwind. Cost savings and lower planned maintenance activity are about a $60 million tailwind for performance materials and coatings. Architectural coatings have been relatively weaker compared to last year, so there may be a slower seasonal return to normal. All three segments are expected to be down at the high end, primarily due to price, not volume. As demand returns, pricing power should come back. Howard Ungerleider replied, at a high level, we're expecting operating results to be flat sequentially. We have $100 million in cost savings, but that will be offset by margin compression and one-time impacts of $150 million. This includes $100 million from project-driven licensing sales and $50 million from the Plaquemine glycol plant. We anticipate a one-time impact of $100 million on margin and cost to rebuild and recommission the plant. We'll provide further updates as we learn more. Mizuho Securities analyst Chris Parkinson inquired, can you provide an update on buyback activity, dividend growth and the coverage ratio for the second half of the year and the 24-27 period? Howard Ungerleider replied, we will continue to be opportunistic in our approach to stock buyback. We estimate $125 million in dilution for Q3 and Q4. Our leadership team has implemented a new strategy where each P&L leader is responsible for their own balance sheet and cash flow statement. This has resulted in 98% cash conversion. We have already done $250 million in stock buyback in Q2 and we expect similar numbers in Q3 and Q4. Additionally, we anticipate $1 billion of unique to Dow cash flow interventions over the next 12 to 18 months, including the Nova litigation which we fully expect to win. As we have the room, we will continue to be even more opportunistic on stock buyback. RBC Capital Markets analyst Arun Viswanathan inquired, what are the main drivers of improving volume in Q3? Is it mainly an improvement in China that would lower days across many of your segments and signal better demand? Jim Fitterling replied, good morning, Arun. China's GDP is still relatively strong at 4.5 to 5%, and India's is even higher at 7%. We're well positioned to serve both markets with our exports of high-value functional polymers. We're also seeing positive signs in North America and Europe, such as lower energy costs, increased housing permits, and mortgage applications. The passage of the Inflation Reduction Act, CHIPS Act, and other infrastructure bills should have a positive impact, although there will be a lag before we see the capital spend. We're also seeing increased demand for wire and cable, coatings for the aerospace industry, automotive, heavy machinery, and automation. As housing picks up, we expect to see an increase in construction and consumer durables, which will be an indicator of the turn in China and North America. Citi analyst Patrick Cunningham inquired, what are your expectations for demand and trends for the rest of the year, and when do you anticipate new siloxane capacity coming online in 2023? Jim Fitterling replied, in 2023, consumer solutions are seeing slower growth in electronics and mobility, while commercial buildings and industrial applications are relatively flat. Home and personal care is up. In coatings and monomers, automotive and liquid applied sound dampening are driving the strongest growth. Architectural applications are down a couple of percent due to the do-it-yourself trend during COVID. Paper coatings are also down year over year. Siloxane's capacity is expected to reach a trough in 2023 and 2024 with 300,000 tons of new capacity added each year. UBS analyst Josh Spector inquired, can you provide an update on the cost savings for Q4 and beyond into 2024? Jim Fitterling replied, in the third quarter, we anticipate a year-over-year cost savings of approximately $350 million. In the fourth quarter, we expect to save an additional $350 million. This brings our total cost savings for the year to $700 million. We also have a sequential carryover of $150 million into the first quarter of next year. We are focusing on cash, both on the cost side and on the $1 billion of cash levers unique to Dow, as well as improving mix within the businesses and taking advantage of our low-cost positions. This will set us up for the ramp-up in 2024. Pankaj Gupta replied, yes, thank you for joining our call and for your interest in Dow. This concludes our call. Thank you.